Hey traders, and welcome to another episode of Smart Risk. In today's episode, we will dive deep into our exclusive liquidity sweep trading plan that could revolutionize the way you approach the markets. We'll be delving into the fascinating realm of exclusive liquidity sweep patterns. A strategy that has the potential to skyrocket your win rates, but we're not stopping there. In this video, we're going beyond theory. We'll walk you through step by step, breaking down the exact entry and exit points. No more confusion, no more uncertainty. Just a strategic roadmap to success. By the end of this tutorial, you'll be equipped with a strategic powerhouse that could potentially reshape your trading career. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back traders. So let's get started. This advanced trading strategy consists of 3 basic instructions that we must follow. Firstly, it's crucial to spot a valid single-candle liquidity sweep pattern on the higher time frame. Moving on, in the second step, we shift to a lower time frame to gain a clearer perspective on the price action and search for any signs of a change of character in the market behavior. Once we confirm the market structure shift on the lower time frame, we proceed to the third step, setting up our entry. Now that we have a general outline of the core steps involved in this advanced trading strategy, let's delve into the details of each step, starting with how to accurately identify a valid single-candle liquidity sweep pattern in the market. In the bearish scenario, the bearish liquidity sweep pattern is formed by the single candle that sweeps out the liquidity above the previous high, including sweeping the high of the preceding candle. This particular pattern tends to occur just before a rapid and substantial downward shift in the market. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate and sharp downward price movement. It is crucial that the price sweeps the liquidity above the highest point of the previous structure using only one candle body or wick. Additionally, the subsequent candle's body or wick should not exceed or close higher than the first candle's body or wick. We want to see an immediate reversal in price direction, with the price returning to the range below the high after the liquidity sweep. In the bullish scenario, the bearish liquidity sweep pattern refers to a single candle that sweeps the liquidity below the previous low and also the previous candle's low, occurring just before a significant upward movement. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate push in price to the upside, with the price returning to the range above the low after the liquidity sweep. A bullish single candle liquidity sweep is considered valid when the price action sweeps the liquidity below the previous low using a single candle's body or wick. It is important that a second candle's body or wick does not form or close lower than the first candle's body or wick. This indicates a strong upward momentum and reinforces the bullish potential of the pattern. Before we proceed to analyze real trading examples and see how we can apply the steps of this strategy in the real price chart, let's take a brief pause to understand the psychology behind this strategy. This will help us establish a solid understanding of how price movement occurs in the market. To illustrate this concept, let's suppose we have structures like this that simulate price movement. If we take a look at this structure, we can see that price initially experienced an upward movement and broke the previous structures to the upside and has created bullish BOSs. Additionally, it created these demand zones, each with the capacity to potentially reverse the price direction upon its approach. Following the sweeping of external liquidity, the price changes its direction to access internal liquidity. This action aims to fill the gaps that were previously left unfilled. In the subsequent, we can see price pushed downwards and reached the upper demand zone, and formed a tiny upward reaction, which is attributed to the buying pressure of traders who entered the market with long positions from this zone. This minor pullback further induces more price action traders to enter the market by going long and placing their stop losses below the demand zone. This collective activity creates a well-defined liquidity zone positioned just below the inducement zone, awaiting the market to sweep it. Traders who have placed their stop losses within this liquidity zone are providing a potential fuel source for the market's momentum. In the following, we can see that price pushed lower and already swept the liquidity below the recent low, with a valid bullish liquidity sweep pattern by using a single candle's body or wick, followed by an immediate push in price to the upside, with the price returning to the range above the low after successfully clearing the liquidity through the sweep. So, we've identified a valid bullish liquidity sweep pattern, presenting a high probability opportunity to potentially execute trades. So, why do we consider this pattern as a high probability setup? We consider this pattern as a high probability setup because in this scenario, the liquidity below the recent low has already been swept. This means that many stop losses have been triggered, leading to a sharp increase in buying pressure. Additionally, the price has started to move upward with significant momentum, indicating a strong bullish bias. Furthermore, it's important to note that there is no significant liquidity pool below this zone due to the aforementioned scenarios. What's the core mindset behind this strategy? The core psychological principle driving this strategy is that when sell-side liquidity is cleared out through a liquidity sweep, the price is then drawn towards the buy-side liquidity, which is aligned with its prevailing direction. When price sweeps liquidity on one side, buy or sell, it often triggers a shift in market sentiment. Traders are then inclined to follow the momentum and seek opportunities on the side where liquidity hasn't been swept yet. This strategy aims to exploit this psychological behavior, leveraging the dynamics between liquidity zones to identify potential trade setups with favorable risk-reward ratios. Now, if we shift our attention to a lower section of the screen, we come across an order block located at the extreme. Now, the question arises, will the price head towards the extreme demand zone, or will it reverse after creating a confirmed bullish liquidity pattern? Notably, in this scenario, you don't have to wait for the price to reach the extreme order block before entering the market. Many traders make the mistake of waiting for the price to reach this extreme order block, expecting it to mitigate the extreme demand. However, in this scenario, the price ignores the lower order block and instead creates a bullish liquidity sweep pattern. It shows a change of character on the lower time frame and sharply moves back to the upside. Traders who wait for the price to come back down and mitigate the extreme demand often miss the trade opportunity. It's crucial to note that this unique trading setup doesn't require waiting for price mitigation of any order block or demand and supply zones. In this approach, trades are executed promptly as soon as valid bullish or bearish liquidity sweep patterns are recognized in the market. Now we have identified a valid bullish liquidity sweep pattern. Our next step is to switch to the lower time frame, closely monitor the price movement, and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the newly recognized order block, in this case, a demand zone on the lower time frame, which is created by the change of characters wave. Alternatively, we can set our entry position on the fair value gaps attributed to the change of characters rally wave. Deciding between these entry models is entirely up to you. However, I strongly advise conducting a backtest over a minimum of 6 months in the market before implementing any of these entry strategies. This way, you can assess which model yields superior outcomes and make an informed decision based on the empirical data. Before using a strategy or setup in a real account, it's recommended to backtest it at least 100 times. To help you with this critical step, we use the TraderEdge platform for backtesting our exclusive trading strategies and setups. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. When these conditions align, we consider a long opportunity, with our target set at the external liquidity, which serves as the take-profit level. Furthermore, if the price fails to make any bullish movement and also hits our stop loss, our attention shifts to the order block situated at the extreme. This order block becomes our high-probability demand zone for a buying opportunity. The rationale behind this is that the price has already utilized the upper demand zone as an inducement area, successfully sweeping the substantial liquidity accumulated below that zone. This liquidity is primarily generated by the stop-loss orders of traders who entered the market aggressively with long positions. Our next step is to patiently wait for the price to reach the extreme order block. Once it reaches this level, we can consider entering a long position after the creation of a valid change of character pattern on the lower time frame. Now that we have a solid understanding of how single-candle liquidity sweep patterns can be utilized in our trading plan to enhance profitability, and also have detailed instructions about how to set up entries based on this strategy. So now, it's time to move into real chart examples. Here we have the Euro-Dollar 1-hour time frame on the screen. As you can see, price is in a strong downtrend and also has created several breaks of structures to the downside. If we zoom into the 15-minute time frame, we can see that price sharply cleared the liquidity above this high with a long wick. Following this, the price immediately reversed and closed below the high's range, and created a valid bearish liquidity sweep pattern. So, we have identified a valid liquidity sweep pattern in the 15-minute time frame. Now our next course of action is zooming into the 1-minute time frame's price chart and waiting for the price to form a change of character pattern. Here, we have the 1-minute time frame chart. As you can see, price created a perfect change of character by breaking and closing below this structure to the downside, and also left an incredible inefficiency behind. Now moving on to the next step, I'll highlight the order blocks created by the change in the characters wave. However, upon closer inspection, it becomes evident that 2 order blocks have been formed by the change of characters wave, and both of them have enough potential to change the price direction. To avoid missing out on this exceptional trading opportunity, I'm adopting a more cautious approach. To achieve this, I'm placing sell limit orders at the lowest points of both order blocks. To ensure risk management, I'm setting the stop losses a few pips above the highest point of the order blocks. As for the take profit targets, I've decided to set them at this recent swing low, as I anticipate that price will move in that direction. Now that we have placed our sell limit orders, let's see how the market reacts and see if our trade setups play out successfully. As the trade progresses, we can see that price initiating a downward movement once our initial sell limit order is executed. It's clear that after addressing the lower order block, the price shifted its direction to the downside. Furthermore, the price continues to decline without triggering the extreme sell order. Eventually, the price reaches our preset take profit target. This trade has yielded a promising reward to risk ratio, demonstrating a successful result. Now let's go ahead and see another example. Once more, we have the euro-dollar 15-minute time frame chart. If we take a closer look at the chart, we see that price has taken out the liquidity above this structure by a single red candle here, followed by an immediate push in price to the downside, with the price returning to the range below the range of the previous high. Consequently, we've pinpointed a valid liquidity sweep pattern. Now we have a valid liquidity sweep pattern. Let's zoom into the 1-minute time frame to obtain a clearer view of price action and search for any sign of a change of character pattern. Now, shifting our focus to the 1-minute time frame chart, we see that the price has created a change of character by breaking and closing below this structure to the downside, thereby leaving behind a significant inefficiency. In the subsequent phase, I am going to identify the order block generated by the change of characters rally wave. Moreover, we can also identify this fair value gap positioned just below the order block. Now, the crucial question arises: which zone should we prioritize for positioning our sell limit order? Should our order be grounded in the order block, or should we focus on the fair value gaps? To answer this query, let me explain my entry approach in situations like these within the market. When faced with scenarios where order blocks and fair value gaps coincide, my preference is to position my entry point at the midpoint of the zone, including both the order block and fair value gaps. This strategy offers the advantage of an optimized entry point and a narrower stop loss. It also reduces the likelihood of trade losses, as there's a chance that after filling the fair value gaps, the price might reverse and move downward without engaging the order block. Placing a sell limit order solely on the order block could result in missing out on a prime trading opportunity. Now, I'm about to position a sell limit order right in the middle of this zone. To maintain a strong risk management strategy, I'll also place the stop loss a few pips above the zone's highest point. My focus for the take profit target is set on this particular swing low, as it presents a significant level where we expect price to potentially reach. Now, we must monitor the market closely and let the trade unfold according to our analysis. Our sell order has been activated, and we are officially in the market. As anticipated, the price moved downward after the activation of the sell limit order, eventually reaching our take profit target. However, as evident from this example, if we had chosen to enter the market using the order block located at the extreme end, we would have missed out on this exceptional trading opportunity. If we had solely relied on placing our entry and exit points based on the fair value gap, it's obvious that our stop loss would have been triggered by the price movement. As I highlighted earlier, it's crucial to conduct thorough backtesting of these entry methods across various currency pairs in different kill zones. This way, you can determine which entry approach aligns best with your trading plan, considering factors such as your trading psychology and approach. That's it, traders. Remember that trading is not just about making profits. but also about managing risks and being disciplined. It takes time and practice to become a successful trader, so don't get discouraged by losses, and always keep learning and improving your skills. Keep up the good work, and I wish you all the best in your trading journey. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.